All right, everyone, let's get started.
Okay, so today we are going to dive into something that's incredibly relevant to pretty much every Canadian, but especially those with modest incomes. We're talking about the GST/HST credit. Now, I want you to think of this less as just theory for an exam and more as a really practical guide to understanding a tax-free payment that you or your future clients might be getting. So here's our game plan. First, we're going to cover the basics, the why and the how behind this whole credit. Then, to make it all make sense, we'll follow a case study. We'll call them Alex and see how it works in real life. After that, we'll look at what happens when life throws a curveball and payments change. And finally, we'll wrap it all up with the key things you absolutely need to remember.
All right, let's jump right into part one. We're starting with the fundamentals. What in the world is the GST/HST credit? And maybe more importantly, why is the government sending people this money in the first place? Well, think about it like this. Sales taxes, like the GST and HST, are what we call regressive. They tend to hit lower income households harder, right? Because a larger chunk of their earnings goes towards basic consumption. The GST/HST credit is basically the government's way of leveling that playing field. It's a completely tax-free payment sent out 4 times a year to give some of that sales tax money back to the individuals and families who feel that pinch the most. Now listen up, because if there's one acronym you burn into your memory from our session today, it's this one, AFNI. AFNI, Adjusted Family Net Income. This is, without a doubt, the most important number in this entire calculation. It's pulled right from your tax return, and it's the number the Canada Revenue Agency, or CRA, uses to figure out 2 critical things. 1, if you even qualify for the credit, and 2, exactly how much you're going to get. It's the whole ballgame. Okay, so numbers and definitions are great, but let's make this feel a little more real. We're going to follow a hypothetical person named Alex. We'll watch Alex's journey from being a single student all the way to starting a family, and we'll see exactly how this GST/HST credit changes and adapts at every single step. So let's start with Alex as a single student. For the 2024 base year, the absolute maximum credit a single person could get is $533. Think of this as our foundation, our starting block. This is the number we begin with before life and income come along and start changing the math. Now, watch what happens when a major life change occurs. Let's say Alex gets married or moves in with a common law partner. You can see right here that 2 massive things shift immediately. First, the CRA isn't just looking at Alex's income anymore. They're now looking at the combined family income. That's our AFNI again. And second, the maximum base credit, that starting point, jumps from $533 all the way up to $698. Big difference. So, let's keep building Alex's story. A couple years go by and Alex and their partner have a child. Well, for every eligible kid under the age of 19, the government adds another piece to the puzzle. For this 2024 base year we're looking at, that amount is an extra $184. And here's how that math all comes together. You take the base amount for the couple, that's $698. You add on the child amount of $184, and you get a grand total of $882. But, and this is a big but, I really want to emphasize that word, potential. This is the maximum they could get before we even start looking at their income. And that brings us to a really, really important point. The number we just calculated, it's not permanent. It's not set in stone. In the real world, this is a moving target. So let's take a look at all the things that can make that number change. So that $882 we just calculated for Alex and their family, is that the final word? No way, not even close. Life is complicated, things change, and when they do, you can bet the CRA is going to recalculate that payment based on whatever new information they get. So what kind of stuff triggers one of these recalculations? Well, as you can see here, it's pretty much all the major life events. A tax reassessment could change your AFNI. A child turns 19. Well, they're no longer eligible, so that $184 drops off. And of course, getting married, separated, or having another child. All of these things will trigger an adjustment to make sure the payment reflects your new family situation. But out of all those triggers, the single biggest one, the one that affects most people, is income. There is a fundamental inverse relationship here, and you need to understand it. When your adjusted family net income goes up, let's say you graduate and get a great new job, your credit goes down. If your income drops, your credit can go up. It's a dynamic system, constantly balancing your income against your credit payment. All right, let's bring this all together.
As students of taxation, and, just as people who live and pay taxes in Canada, what are the absolute bottom line things you need to walk away with today?
Look, if you remember nothing else, remember these 3 critical actions. They are non-negotiable. Number 1, always file your taxes, even if you made 0 income. No tax return means no assessment, which means no credit. Simple as that. 2, keep your information current. Tell the CRA as soon as your life changes. It saves you so many headaches later on. And 3, it all comes back to AFNI. Understand that number, and you pretty much understand the whole system.
And I want to leave you with what might be the single most powerful concept here, especially for you as students. This credit is refundable. In the tax world, that's a magic word. It means that even if your income is so low that you owe $0 in income tax, the government can still send you money. This isn't just about making your tax bill smaller. This is about actual cash in your pocket.
So, I'll leave you with a question to chew on. We started this session by saying sales taxes can be regressive. So my question is this. How does it targeted, refundable credit, like the GST/HST credit, act as a counterweight? How does it help push our entire tax system in a more progressive direction? Think about that, mull it over, and we'll pick it up in our next class. That's all for today.